Today we're going to talk about receivables. We're going to start with Chapter 9, Receivables, and we're going to learn how to classify receivables. We're going to talk about some receivables that you may already know about. We're going to also talk about some receivables that you don't know about. We're going to talk about how to account for receivables that we cannot collect. So we're going to be working with Chapter 9 today, and so if you will bear with me while I get our chapter loaded up for us. Okay, are you able to see your textbook? Brandon, I saw that you entered in the classroom. Are you able to see the textbook right now? I don't hear you speaking to me, so I'm going to stop sharing this and we'll try it one more time. Are you seeing Blackboard?
Yeah, I'm just seeing the just a blank screen right now for Blackboard.
Okay. Let me try this again. Okay. Can you see it now?
Oh yes, I see the text now.
Okay, wonderful. All right. What I want to talk to you today is about our receivables in this chapter. We're working in Chapter 9. You already know about one of the types of receivables that we're going to be talking about, and that is accounts receivable. You'll remember that accounts receivable is an asset account, and accounts receivable is usually collected within a short period of time. It can be collected either on 30 days or 60 days or even 120 days. But accounts receivable is usually generated because we have sold merchandise to our customers on account, or we've sold service to our customers on account, which means that they're going to be paying us later. So you'll remember that we said in Chapter 1 that all receivables are asset accounts, and so accounts receivable is definitely an asset account. It will be considered a current asset if it is collectible within 1 year. And since most accounts receivables are for 30 or 60 days, then they are definitely considered to be current assets. So accounts receivable is a current asset. You would recognize it at the end of the accounting period on your balance sheet. And that's the way we would report accounts receivable. Another type of receivable that we have not talked that much about is what we call notes receivable. The main difference between accounts receivable and notes receivable is that notes receivable is a formal written document that is backed up by a promissory note that usually carries some interest on it. If the notes receivable can be collected within 1 year, we'll consider it to be a current asset. But sometimes notes receivable will last for longer than a year, and in that case, we would consider them types of investments. And that's a new category that we haven't talked about yet, but you will be learning about in the future of assets. So if it's a notes receivable and the notes receivable is for less than a year, then we will consider it to be a current asset. And so notes receivable can carry interest with them. And later on in the chapter, we'll be discussing how to calculate simple interest off of notes receivables. So notes receivables, again, are amounts that customers also owe us, but we've required them to sign a formal document that tells them that they owe us for an expected amount to be collected. And if it's going to be collected within a year, we call that a current asset. What we're going to be using notes receivable for in this chapter is that we might use a receivable to settle a customer's account receivable. So if you've established a customer's account receivable and you find out that the customer cannot pay you on the due date, you may extend the due date of the account by giving them a note in exchange for that account. Usually notes will draw some type of interest that you can earn off of those notes. And so notes can be given in exchange for a customer's account receivable if the customer is either slow paying or they're not able to pay us within the due date of the account. There are some other receivables that you need to be aware of that are also assets on the balance sheet. And some of the other receivables will include interest receivable, which we would establish when we are accruing our interest at the end of the accounting period in an adjusting entry. We'll want to determine how much of the interest is receivable during the period of time that it has accrued in. And so interest receivable is another type of receivable that we may talk about in this chapter. Taxes receivable, receivables from officers or employees, any type of receivable is considered to be an asset. If we can collect that asset within 1 year, then we will call it a current asset. If the collection is beyond a year, then we will report it in our investments section of the balance sheet. So what you're going to find out is that our balance sheet not only includes current assets and plant assets in our balance sheet, but there's going to be a new category called investments. And this is where we're going to record our notes receivable. If they are longer than a year, they will go in the investment section. If any receivable is classified as the collection will be beyond 1 year, then they will be considered to be non-current assets, which will be investments. So if we loan someone some money for a long period of time, it will go in the investment section of the balance sheet. The investment section can also be used for investments where we might take some of our idle cash and invest it in another company's stock for a long period of time. Those would also be considered investments, and those we will talk about in another chapter. So what the main part of this chapter is about, it's about customers that you have allowed to buy merchandise from you on credit, and they may become or may not be able to pay the amount that they owe to the company. And if they cannot pay the amount, then it will become an uncollectible account. And we have to know how to record that on our books should we have a customer that cannot pay us the accounts receivable that they owe to us. There will be two methods that we use in this chapter to record uncollectible accounts. The first method is what we call the direct write-off method, and the second method will be what we call the allowance method. We'll probably start with the direct write-off method first because it's the simplest of the methods to use. What the direct write-off method will do for us when we have determined that a customer is not going to be able to pay us the amount that they owe us, we'll go ahead and directly record the amount in what we call a bad debt expense. So a new account in this chapter that we're going to be talking about is bad debt expense. Sometimes we call these bad debt expenses uncollectible accounts expense. Either way, in either term, bad debt expense or uncollectible accounts expense, both of these accounts are expense accounts and will end up on your income statement. The bad debt expense is an administrative expense and will end up in your operating expenses that will go on your income statement. So if you're preparing a multi-step income statement like we did in Chapter 6, the bad debt expense would show up in the administrative expenses portion of our operating expenses on the income statement. The direct write-off method is used by companies that do not have a whole lot of uncollectible accounts. It's a simple method to use. Some companies prefer to use that, but it is not the best method that we can use to account for uncollectible accounts. An organization that establishes the rules for accounting is what we call the Financial Accounting Standards Board. For short, we call it the FASB organization. The FASB organization does not promote the direct write-off method, but they do tell you that it is acceptable if your company does not have a material amount of uncollectible accounts that they expect that they will be writing off in the future. So we can use it, but it's probably not the best method to use. FASB recommends that companies that have a significant amount of uncollectible accounts, that they would consider these accounts to be material, they will use the allowance method for recording the uncollectible accounts. So with the allowance method, what we have to do is estimate up front what our uncollectible accounts were going to be at the end of the accounting period. We will have to make an adjusting entry to do that. So not only do we have to create an adjusting entry at the end of the time period of the accounting period, we also are going to have to write off the accounts using an allowance account. So the allowance method is a little bit more complicated than the direct write-off method is. But the allowance method should be used for companies who have a large amount of write-offs. If it's a smaller amount of write-offs, the direct write-off method can be used for writing off accounts. So we're going to look at the direct write-off method first because it is the simplest method to be used. And with the direct write-off method, what we do is we establish a bad debt expense when we know for sure that a customer's account is going to become uncollectible. We might be notified by a lawyer that our customer has filed for bankruptcy. We might have had the customer's account on our records for a long period of time, and so management comes in and says, I don't believe we're going to be able to collect from this particular customer, so we should write it off. In any case, the journal entry that you would make to write off an account under the direct write-off method will debit the bad debt expense, because expenses increase on the debit side. We're going to debit those bad debt expenses in our journal, and we know for sure that we're not going to collect from a customer. And the illustration that we're looking at on this page is for a customer called D.L. Ross, and we were expecting to receive from this customer $4,200. That's the amount that he owed, but for whatever reason, whether he has declared bankruptcy or whether our management has just come in and told us that we're not going to be able to collect from this customer, that they've been past due too long, then we'll write off the account. So in the journal, we would debit bad debt expense and credit our accounts receivable as the write-off entry. So once we've written off the account is deemed to be uncollectible. Our accounts receivable will be credited for the amount that we are believing that our company will not be able to collect. And so we write off an account through a write-off entry. Now, this write-off entry can occur at any time that we deem it necessary to write off a customer's account. But usually it will be because a lawyer has notified our company that the customer is declaring bankruptcy, or it may be, like we said, we've been carrying this accounts receivable on our books for a long period of time and management has just given up on collecting from this customer. This is the entry that we would record for the write-off entry for the direct write-off method. Now, sometimes what will happen after you have written off an account, the customer may come back to us and say later on, I want to make this account right with you. I want to reestablish my credit, and so I'm going to pay you the amount that I originally owed you. If that is the case and we've already written off that customer account, we're going to need to record two journal entries. The first journal entry is to reinstate the customer account for the amount that that customer is willing to pay us. So in this example, it says, to illustrate, assume that D.L. Ross account of $4,200 that was written off on May 10th is later collected on November the 21st. So notice our date is November the 21st. The first journal entry has to reestablish that accounts receivable and put it back on our books. If you'll notice, it's exactly opposite of our write-off entry. So what we would do is we would debit accounts receivable and credit our bad debt expense for $4,200. We have to put the accounts receivable back on our books by debiting it, and then we have to just pretend like that bad debt expense never happened. We have to take it also back off of our books. So we end up debiting accounts receivable because we're increasing the asset account, again, putting it back on our books, and then we will decrease our bad debt expense because our expenses would have gone down in this situation because this customer is paying us the amount that they originally owed us. The second journal entry will be for us to record the amount of cash that we have received from that customer. In this case, the customer, D.L. Ross, is paying us $4,200. Our cash account is increasing, so we would debit that on our journal, and then we would take the accounts receivable back off of our books by reducing it by $4,200. What really happened here is you debited the accounts receivable, and then you ended up crediting the accounts receivable, which made the accounts receivable go away. We have our cash now, our cash is debited, and our expenses went down because it's no longer a bad debt expense. The next method that we need to talk about is the allowance method. Again, we would use the allowance method if we anticipate that we're going to have a whole lot of customers that cannot pay us what they owed us originally. And so we're going to estimate the amount to become uncollectible at the end of the year, and we're going to create a journal entry for the estimated amount that will become uncollectible in the future. Notice it's an estimated amount that we're talking about here. So we have to have some way to base that estimate. A lot of companies use their credit history about customers who have not paid them in the past to use as a way to estimate the amount of the uncollectible accounts. At the end of the accounting period, when we're using the allowance method, we have to first estimate what we think the uncollectible accounts are going to be in the future. So we're going to create an adjusting entry that would go with our other adjusting entries at the end of the accounting period, such as our accruals and our deferrals that we talked about in a previous chapter, our depreciation expense, all those adjusting entries that we learned about. This is another adjusting entry that we would keep track for if we had a large amount of accounts that we expect are going to be uncollectible in the future. We would use the allowance method in that case, and when we use the allowance method, we have to create an adjusting entry for the estimate of the uncollectible accounts. So on your screen, you can see this adjusting entry. You can see at the end of the accounting period, they are estimating that the bad debt expense is going to be $30,000. Expenses are going up, so we're debiting these expense accounts, and we're crediting a brand new account that they introduce in this chapter called the Allowance for Doubtful Accounts. Now, I want to emphasize to you what the Allowance for Doubtful Accounts is so you'll understand how it is reported in our financial statements. The allowance for doubtful accounts is what we call a contra asset account. It is contrary, or it offsets the accounts receivable account on your balance sheet. You might remember from a previous chapter that we talked about another type of contra asset account. That account that we talked about was accumulated depreciation. You'll remember we said that a contra asset account has a credit balance. It increases on the credit side instead of the normal debit balance of an asset account. So because this allowance for doubtful accounts is considered to be a contra asset account, it's going to have a normal increase side or a balance side on the credit side. So you'll notice that in this transaction, they have credited the allowance for doubtful accounts for $30,000. This is the total amount that they are estimating that will become uncollectible in the future. At the end of the accounting period, we're going to have to put some money in the allowance for doubtful accounts that will cover the estimated amount of uncollectible accounts at the end of the accounting period. So your adjusting entry for the allowance method will have you debiting bad debt expense and crediting the allowance for doubtful accounts. Now our expense account, bad debt expense, has a balance in it of $30,000 at the end of this accounting period. This would be added to the balance in the bad debt expense account. The allowance for doubtful accounts will have a balance now in the allowance account for $30,000. Next year, when we write off actual accounts that become uncollectible, we'll write off the accounts against this allowance for doubtful accounts. But you have to have the allowance for doubtful accounts established before you can write off any uncollectible accounts against the allowance account. So what you need to know about the allowance for doubtful accounts is that it is a contra asset account. It will have a credit balance. It will increase on the credit side. And because it is still considered to be an asset, it will show up on our balance sheet in the asset section. The allowance for doubtful accounts will go directly underneath accounts receivable because it's going to offset the accounts receivable account on the balance sheet. So the allowance for doubtful accounts is a contra asset account. This is your adjusting entry that you have to make before you can write off any accounts using the allowance method. Now, the next part of this is showing you how to create a journal entry to write off an allowance account. When we have deemed that the customer is not going to be able to pay us for whatever reason, we are actually going to write off the account against the allowance account. So the write-off entry for an account that is for an accounts receivable that we are using the allowance method as our method for recording uncollectible accounts, we are going to have to debit the allowance for doubtful accounts for the actual amount of the write-off. What this debit does to the allowance for doubtful accounts is it reduces it. When we debit allowance for doubtful accounts, we are decreasing the balance that is in the allowance for doubtful accounts. So we debit the allowance for doubtful accounts when we're writing off a customer account, and we are crediting our accounts receivable to show that this customer is not going to pay us the amount that they owe to us. So as this illustration states, on January 21st, that's in the new accounting period, when we're using the allowance method, John Parker, our customer's account of $6,000 is going to be written off. And to write off the account, we would debit the allowance for doubtful accounts to reduce the estimated amount that we had previously put in the allowance account, because the customer is actually not going to pay us. This has actually happened, and we will now write off the accounts receivable, which means we are crediting our accounts receivable to show that it is being reduced. This is how we write off an accounts receivable using the allowance method. Something that I want to show you, or I want to emphasize to you, is the T account, for the allowance for doubtful accounts. This allowance for doubtful accounts is for the X-Tone company. That's what we're going to be. And it says to illustrate that during 2000 Y8, the X-Tone company writes off 26,750 of uncollectible accounts. And that included 6,000 that was in the account of John Parker that we recorded previously on January 21st. The allowance for doubtful accounts will end up with a credit balance of $32.50. Let me emphasize to you how they got that. They had an original balance that they estimated at the end of the last period in their adjusting entry that they made. They said that they estimated a total amount will become uncollectible in the future. I'm going to go back for just a minute to show you where that $30,000 balance came from. This is where the $30,000 credit balance came from. This was the adjusting entry that you made at the end of the accounting period. So this balance that we had at the end of the accounting period is going to be brought forward into the new accounting period. That's where this $30,000 comes from. Now you'll remember that we wrote off John Parker's account for $6,000. Notice we debited the allowance for doubtful accounts for $6,000. So right here on January 21st, we had a debit to the allowance for doubtful accounts for $6,000 that was from that customer that we wrote off. In this T account here that they're showing you, they have also written off additional customers. The total of all of the accounts that they wrote off during the period is $26,750. These little dots here represent other customers that they wrote off during this accounting period. So at the end of the year, we will rebalance our allowance for doubtful accounts, and what we're going to have is an unadjusted trial balance amount of $3,250 as the remaining balance that is left. Again, the beginning balance, $30,000, was brought forward from the ending balance last period. It becomes the beginning balance this period, and then we write off our accounts, which totaled $26,750. So there will be a remaining balance in the allowance for doubtful accounts at the end of the accounting period at $3,250. Now, in the second allowance for doubtful accounts that we're looking at, this is a what if this happened. It says if Xstone had written off $32,100, then there would be a remaining debit balance in the allowance for doubtful accounts before you have created your adjusting entry. And so this would be the unadjusted balance if we wrote off more uncollectible accounts than we estimated. So what this is saying to you here, class, is that the allowance for doubtful accounts should normally have a credit balance at the end of the period. But sometimes before we adjust our balance, before we create our adjusting entry to estimate the amount of the uncollectible accounts, we could have a temporary debit balance in our account before the adjusting entry. And that's exactly what happened in this second what if analysis. You'll remember that last year we estimated that $30,000 was going to be uncollectible, and so that's where they got the beginning balance. Then we wrote off that account on January 21st, and we wrote off another one on February 2nd, and we wrote off all of these other accounts until we got to $32,100. we wrote off more, or we had more debits than we had credits. So this unadjusted balance can temporarily become negative. And this is before the adjusting entry is processed. So sometimes allowance for doubtful accounts can have a negative balance for it. Now on this next part, what they're showing as an example where we have a journal entry, or we have two journal entries, is if we have previously written off a customer's account, that customer might come back to our company and say, oh, I've got the money now. I'd like to pay you the amount that I originally owed you. And so if that happens, we'll gladly accept their money. But what we're going to have to do is reestablish the accounts receivable for that customer account that is going to pay us after we have written off an account previously. So in this illustration, it's saying assume that Nancy Smith's account of $5,000 was written off on April the 2nd. It's been previously written off, and they use the allowance method. In the write-off entry, we would debit the allowance for doubtful accounts and credit accounts receivable for $5,000 for Nancy Smith's account. When we are receiving payment from that account that we have originally written off, we've got to reinstate the account. In other words, we reverse out the write-off entry. So we are going to debit our accounts receivable for $5,000 to put the accounts receivable back on our books for Nancy Smith, who's saying that she's going to pay us today. We're going to credit the allowance for doubtful accounts to reverse that back out of the allowance account. And then we will accept her cash, so our cash would be debited, and then the accounts receivable would be credited. In other words, we reestablished her account only to make it go away when we have the money for that account. So our cash account is increased, our accounts receivable would be decreased. It would take it off of the books, the accounts receivable portion, and we would have reversed out our allowance for doubtful accounts. It is no longer a write-off entry, so we had to pull it back over as a credit to the allowance account. So that's what happens when we reinstate an account. In the next part of this, I'm going to wait and talk to you about that again on Friday before we can get into discussing our problems. So I think I've probably given you enough information today. So I want to stop here, and then on Friday when we come back in here, I will talk to you about how we estimate the amount of the uncollectible accounts. So I'm going to stop here, and I'm going to ask you if you've got any questions so far about anything that I've talked about at this point in time. I don't hear any questions, so I'm going to stop sharing this with you. And I'm going to stop our recording.